Good afternoon, everyone. Thank you for attending today's session. We are here today excited as we continue celebrating Financial Literacy Month. It's a time dedicated to enhancing our understanding of financial principles and practices that empower us to take control of our businesses. This celebration is important because it's the perfect time to remind us of the importance of being informed, organized, and proactive in managing our finances, both personal and business. I want you to be prepared to learn the significance of maintaining accurate records and the impact it can have on your overall business health. Now, before I get started and turn it over to Anika, a few housekeeping notes. First, the chat and the Q&A. If you are on a mobile device, in order to access the chat and the Q&A, or specifically the Q&A, you may need to click on those three dots at the bottom of your screen and then select Advanced, and then scroll down and you should see the Q&A. For those individuals that are on your desktop or using a tablet, there are three dots at the bottom of your screen to the right. Click on those dots and you should already see the chat or the Q&A. But if you don't see either, click on those three dots and one or the other will appear. You can also click on, there's a square with an arrow at the upper top side of the box, and it will actually open up the chat for you so that you'd be able to see the chat and the Q&A as you're also viewing the session. And that's most useful for those individuals that are using two screens. Now, please input your questions into the Q&A. It helps us to easily track your questions to make sure that we are responding to them during this live session. And just in case, if we're not able to get to your questions during the live session, we will follow back up and respond via email that you registered with a response. Everyone is muted except for the panel. Depending on the size of the group, I see we're almost at 200. That'll depend on whether or not I open up the session for you to be able to raise your hand. I don't think those on the phone who have dialed in will be able to do that. But for those that are in the mobile app or that are using the web browser or on the computer, you may be able to raise your hand. And when we are going over the Q&A, you'll be able to come off of mute and ask your question. This session is being recorded, and a link of the recording and the presentation will be sent to everyone to your email address. It'll approximately be in about 2 days. So I just want to thank Ms. Anika Pompey and Ms. Cheryl Jackson from the Internal Revenue Service today for attending. Thank you for presenting this for the small business community, the veteran small business community. And now, Anika, I will turn it over to you.
Thank you so much, Wendy. And thank you for inviting us back. We've established a really great partnership over the years. So I always look forward to coming and doing presentations with you all. So you can advance it to the next slide. So as Wendy mentioned, my name is Anika Pompey, and I am joined by my colleague, Cheryl Jackson. We are both stakeholder liaisons with the Internal Revenue Service. And as stakeholder liaisons, we are responsible for establishing and maintaining relationships with tax practitioners, business organizations, and other audiences for the purpose of providing education and outreach on IRS policies, practices, and procedures. What better presentation to offer you all today than business record keeping? So let's go on to the next slide. All right, so for today's workshop, we're going to cover a few different topics in regard to record keeping. So first, we'll go over the uses of record keeping. Then we'll discuss how to record business transactions. Next, we'll talk about the type of records that you need to keep. And then we're going to close out with discussing record keeping timeframes. Now, before we get started, I do want to share that this information that we're sharing with you today is general information only. This is not tax advice. But should you need tax advice for your business, we do recommend consulting with your trusted tax professional or with your business advisor. Next slide. All right, so let's begin with why we keep records. Now, everyone in business has to keep records. It is very important to your business that you keep good records because it's going to help you in several different ways. First and foremost, it's going to help you monitor the progress of your business. You're going to need good records to monitor the progress of your business. Records are going to show you whether your business is improving. It's going to let you know which items or services are selling, or what changes you need to make to improve profitability. And if you're keeping good records and analyzing them regularly, you can make the necessary adjustments to how to operate and increase the likelihood of your business success. Next, you're going to need records to help you prepare your financial statements. Now, good records are going to help you prepare accurate financial statements, and that's really important. These include income statements, also referred to as profit and loss statements, as well as your balance sheet. Now, an income statement is going to show the income and expenses of the business for a given period of time, whereas the balance sheet is going to show your business assets, liabilities, and your equity in the business on a given date. Now, these statements can help you in dealing with your bank or creditors. They'll help you manage your business. So, for example, if you want to apply for a loan to expand your business, your records are going to play a pivotal part in whether or not you receive that loan, because you're going to need to demonstrate to the bank your profitability and cash flow. If your records are not in order, it could result in the denial of that loan. Now, your records are also going to help you identify sources of receipts. So as you're operating your business, you're going to receive money and or property from many different sources. Now, your records can identify the source of your receipts. You need this information to separate your business receipts from your non-business receipts, as well as your taxable income from your non-taxable income. Your records are going to also help you keep track of your deductible expenses. Now, you may forget about expenses when you prepare your tax return if you're not regularly recording your expenses. You don't want to miss out on deductible expenses, so you should make a habit of regularly recording and reconciling, recording your expenses as well as and reconciling them as well. And, just recently, during tax week, actually, my colleague here in DC, we did a few small business events where we set up as exhibitors. We answer questions for small businesses. And one of the small business owners that visited our booth, he was explaining how, he took care of his record keeping on his own. And he said he felt like, he might be missing out on deductions. So I asked him, I said, well, how often are you recording your expenses? What do you mean you're missing out on deductions? And he said to me, he records his expenses quarterly. But I tell you, I grasped my pearls. And, not just because he more than likely is missing out on deductions, but, as the former auditor in me also was shocked because your records need to be in order in case that you are, contacted by the IRS for an audit. And that brings me to the last topic. You're going to need those records to prepare your tax return, and not only prepare it, but to support the items on your tax return. So when it comes tax time, your records are going to help you prepare your tax return. These records, they have to support the income on your returns as well as any expenses or credits that you claim. It's also important to note that you must keep your business records available for an inspection by the IRS. So if the IRS does audit any of your tax returns, you might be asked to explain the items reported on your tax return, and a complete set of records is going to help you, is going to help speed up, the process of the examination. But also, if your records are complete and you are, you're claiming your deductions in accordance with the tax law, that audit should result in no changes. So again, make sure you guys are keeping those records. All right, let's move on to the next slide. So now that we have an understanding of why you have to keep good records, let's talk about how to record your income and expenses. Now, there are several types of record keeping systems that you can use. A good record keeping system is going to include a summary of your business transactions. And your business transactions are ordinarily going to be summarized in books called journals and ledgers. Now, a journal is a book where you record each business transaction shown on your supporting documents. You may have to keep separate journals for transactions that occur frequently. And then your ledger, that is a book that contains the totals from all of your journals. Now, it is organized into different accounts. So ledger accounts show income, expenses, and assets, which are the property that's owned by your business. And they also show liabilities, which are the debts that are of your business. And they should also reflect your net worth, which is excess of assets over liabilities. Now, it's 2025, and a lot of us, in the digital age, we are using computer software programs. And there are many computer software packages that you can use for record keeping. Just to give you an example, I'm pretty sure all of you have heard of QuickBooks, right? That's an example of a really popular type of bookkeeping software. And you can purchase these softwares over the internet as well as in retail stores. And these packages can be very helpful and relatively easy to use. They require very little knowledge of bookkeeping and accounting. If you do use a computerized system, you must be able to produce sufficient legible records to support and verify entries made on your return and determine your correct tax liability. And then to meet these qualifications, the machine sensible records, they must reconcile to your books and returns. And these records must provide enough detail to identify the underlying source of documents. So again, I mentioned that a couple of weeks back, me and my partner here in DC, we were doing exhibiting at a few different small business expos. And one of the questions that came up, one of the small business owners asked, he said, I guess another friend of his who was also in business told him that, you just need to keep the bank statements. The bank statements will show, the bank statements should be sufficient. So he asked me, was that good advice? My advice to you all, bank statements are a good record, but the receipts are also very good records because your receipt, and we're going to talk about this in the upcoming slides, but your receipts are going to show what was purchased, the date the purchase was made, who was paid. So I recommended to him that he uses a computerized software program for record keeping. But I let him know, I said, look, these software programs give you the option to upload a receipt with the entries that you make. I said, it doesn't hurt to just snap a picture of a receipt or an invoice and upload that with the entry that you enter into your books. And it makes it a lot easier later on when you're trying to determine or whether or not this expense is, related to business. So again, if you're using a computerized program, definitely snap a picture of that receipt, invoice, statement, and upload it so that it's associated with that entry into your system. All right, so we can move on to the next slide. All right, and I do also want to mention that the system that you use to record your business transactions is going to be more effective if you follow good record keeping practices. So a good example would be to record your expenses when they occur. I understand that you all are operating businesses, so it's probably not feasible to record your expenses every day, but the more frequently you can record your income and expenses, the better off your records will be. So let's talk about the business bank account. One of the first things you should do when you start a business is open a business checking account. You should keep your business account separate from your personal checking account. And this is going to be very important because you do not want to commingle funds. The business checkbook or the business account is your basic source of information for recording your business expenses. But again, it shouldn't be the sole source. You should also deposit all of your daily receipts in your business checking account. And to make sure you identify the source of those deposits as either business income, personal funds, loans, grants, whatever source they may be, make sure you identify it at the time that it's recorded. And you should also note on the deposit slip, if deposit slips are even being used anymore, but if in fact you are making deposits using the deposit slips, make a note on that slip, the source of the deposit, and keep all copies of your slips. I know a lot of banks are going digital now, and even when you go into the bank to make a deposit, you don't even have to fill out a slip anymore. They tell you to, they have virtual tellers now. They just tell you to enter your card, and they just, they do the transactions over the video monitor, and it's not really much paper involved. But if your bank is old school and you still use deposit slips, make sure you keep a record of that deposit slip. Now, it is best to make all payments by either your check or by a check or your debit or credit card associated with your bank account. And this just makes it easy to document the business expenses. So if you have to write a check payable to yourself, only do so to make withdrawals from your business for personal use. And avoid writing checks payable to cash. If you have to write a check that's for cash to pay a business expense, make sure you include the receipt for the cash payment in your records. And if you can't get a receipt for a cash payment, you should make sure you document an adequate explanation in your records at the time that the payment is made. And again, use the business account for business purposes only. I cannot emphasize this enough. As a former auditor, I had small business owners come in all the time for audits, and they were just paying everything out of the business bank account. And I understand it might be easier because the money is already there, but if you need funds out of the business account for personal expenses, just take that extra step to withdraw that money and put it into your personal account and take care of your personal expenses from your personal account. Now, when you receive your bank statements, you want to make sure that your statement agrees with your books. So the statement balance may not agree with the balance in your books and the statement if it includes bank charges that you either haven't entered into your books and subtracted from your account balances, or if it doesn't include deposits that were made after the statement date, or maybe if you wrote a check, maybe the check didn't clear before the account statement date. So by reconciling your checking account, what you're going to do is you're going to verify how much money you have in the account. You're going to make sure that your books reflect all bank charges and that the correct balance in your checking account. And you're also going to correct any errors in your bank account or in your books. So as a best practice, you guys really should be reconciling your checking accounts each month. Next slide.
Hey, Anika, we had 2 questions to come in about this information.
Okay.
The first question is, what about when you fund your business from your personal account? How do you handle that?
Well, I don't recommend you funding your business from your personal account. Now, and I understand when you're first starting out in business, sometimes you're not able to open up a business account. So I know some accounts require you to have an employer identification number. Others of them might require that you set up your business in a certain way, such as a limited liability company. So my suggestion to you all, and again, this is not advice. I consult with your tax pro or your business advisor, but I was told in the past that if you have to run your business from a personal checking account, then have more than one personal checking account and designate one for business use only and designate the other for personal use only, if that makes sense.
Thank you. The next question, would it make more sense to use a payroll company to pay yourself for your personal expenses?
Well, that it does make sense, but again, whether you pay yourself is going to be based on how your business is set up. So if you are a sole proprietor, or you a sole proprietor, or maybe like a single member LLC, you are filing your your business income and expenses on a Schedule C, and as a sole proprietor, you don't pay yourself technically. The bottom line, after you net after you subtract your expenses from your income, that total profit or loss is considered your income. But if you're set up as like a partnership or a corporation, then certainly you can set yourself up as an employee of that partnership or corporation and pay yourself a wage.
I'm not sure if this is a question. Patrick, you said not making additional capital investments with a question mark. Is that in reference to something that was being discussed earlier? And I see
it might be in reference to when I was saying that you recording your income. And again, capital investments aren't necessarily income, but it should be reflected in your books. And then you just make sure that you notate it as a capital investment, so that if for some reason you are audited and an auditor is looking at your books as well as your bank statements, they can see that a certain deposit made on a certain date was just a capital investment into the business and not necessarily income received in business. But if he wants to clarify that,
he said yes,
by all
that's
means.
correct.
Okay.
Yeah, thank you, Patrick, for clarifying. I see that there were a few more questions that came in. Everyone, if you could please place it in the chat, because we definitely don't want to miss your questions that you have. I'm sorry. If you could please place it in the Q&A, because we don't want to miss the questions that you have. Anika, I'm going to pass it back over to you so that we can move on, and then we'll definitely come back to your questions. But make sure to place them in the Q&A so they don't get lost in the chat. Thank you, Anika.
All right, no problem. Okay, so far we have covered why we keep records and various record keeping systems. So now we're going to move on and discuss the type of records that you should be keeping. And we're going to start with gross receipts. So gross receipts are the income that you receive from your business. And you should keep supporting documents that show the amounts of your gross receipts as well as the sources of your gross receipts. So some examples of documents for gross receipts include cash register tapes. Now, cash register tapes might be a little dated at this point because, again, there's been so many technological advances. So actual cash register tape is probably not something that we see very often because many businesses have moved to the electronic point of sale software. But if you are using the electronic point of sale software systems, just make sure that you're saving the data from those sales. Another example would be deposit information, and these are from cash or credit sales. So if you receive payment via cash or check, and then you subsequently deposit it, make sure that you are keeping record of the deposit information. Another example would be, and I don't want to back up to deposit information, because some businesses that receive cash, sometimes, let's be honest, sometimes that cash doesn't get deposited, and that's okay if you're not depositing it into your business bank account. But still, make sure that you are recording the cash that you receive into your records. Some people like to skirt and say, not include that cash, those cash payments. But what I will say is that in the future, again, if you're trying to get those grants and loans and you're not recording that cash income, your business is going to look cash poor, and you might shoot yourself in the foot and not get that that help that you need. Another example will be the receipt books. Receipt books are a good way to document income, especially for cash-intensive businesses. So you can provide a copy of the receipt to your customer client, and then just make sure you keep the duplicate copy for your records, and make sure that you're recording those receipts into your books at a later time. Another example of supporting documents for gross receipts are going to be invoices. So your invoices are always a good way to document income as well. So just make sure that you maintain copies of the paid invoices that you've issued to support your income. And then lastly, you have your Form 1099 miscellaneous and your Form 1099 NEC. So those of you who get contracted to do work, you sometimes may be issued a 1099 from your payer. But what I will say is you shouldn't rely solely on this document. You should be recording the income that you receive from them as you receive it. Because some payers, they might not issue a 1099 because they're not required to, or maybe they paid you less than the threshold for reporting, which is $600. And even if you strictly, if you strictly rely on this document, it may result in you understating your income. So just be careful with that. All right, so next slide. So let's talk about supporting documents for your purchases and expenses. So your purchases are going to be the items that you buy and resell to your customers. So if you're a manufacturer or a producer, then this can include the cost of raw materials or parts that you purchase for manufacturing your finished products. Now, expenses are going to be the costs that you incur to carry on your business. So your supporting documents for purchases and expenses should identify the payee, the amount paid, proof of payment, and the date that that payment was made. And in some cases, it might require a description of the item to show what was purchased. So some documents that would be sufficient for supporting purchases and expenses are going to include sales slips, paid bills, account statements, invoices, receipts, as well as cancel checks. Next slide. Now, there are some expenses that you'll deduct in business that are going to require some additional documentation. So if you deduct travel, gift, or transportation expenses, you have to be able to provide or prove, certain elements of these expenses. Now, you have to keep adequate records to prove your expense or have sufficient evidence that is going to support your own statement. And you generally have to prepare a written record for it to be considered adequate. So what are adequate records? Adequate records basically include items such as account books, diaries, logs, statements of expenses, or similar records. And you're also going to need to keep documentary evidence that together with your record is going to support each element of your expense. So your documentary evidence are going to include items such as receipts, canceled checks, bills, and other types of invoices to support your expenses. Now, you should record the element of an expense at or near the time of the expense for it to be considered sufficient documentary evidence. And a timely kept record is going to have more value than a statement that is prepared later when you probably don't really recall all of the details. Now, you don't need to write down the elements of every expense on the day of the expense, but again, if you're maintaining a log, maybe on a weekly basis that accounts for use during the week, then the log is going to be considered a timely kept record. All right, so let's move on to the next slide. So let's go into more detail with each of these. Now, if you incur travel expense in the course of conducting business, then the records for your travel are going to have to include certain details. And so it should include the following information. First and foremost, it has to include the cost of each separate expense for travel, lodging, and meals. It also should include the date that you left and returned for each trip and the number of days spent on business. It also should include the destination or area that you traveled to. And then it should also include the business purpose for the expense or the business benefit gained or expected to be gained. And the document should show the amount, date, place, and essential character of the expense. So let me just give you an example. If one expense that you might incur when you travel, of course, is going to be hotel or lodging. So while the hotel receipt is enough to support the expense for business travel, it will be enough to support it if it has all of the following information. It has to have the name and the location of the hotel. It has to include the dates that you stayed there, as well as any separate amounts or charges for like lodging, meals, telephone calls, etc. So travel expense will be one of those situations where it's just not enough to show a transaction in your bank accounts like, hey, see right here, I stayed at the W in Nashville. We have to have additional records to reflect the other information as well. All right, let's go to the next slide. All right, so if you are incur an expense for gifts while conducting trade or business, then that record must reflect the cost of the gift, the date of the gift, as well as a description of the gift. So although the gift expense is limited to $25 per gift, your record should reflect the full amount paid for each gift. So again, this is another situation where just showing someone that you made a purchase, let's say at Edible Arrangements, is not going to be sufficient. Your bank statement will show the cost, but it won't indicate the date of the gift or when you gave the gift away, a description of what that gift was, or even who the recipient of that gift is. Now, you don't always have to record the name of each recipient of a gift. A general listing would be enough if it's evident that you are not trying to avoid the $25 limit on the amount that you can deduct for gifts for any one person. And that's a $25 annual limit for each person. So for example, if you buy a large number of tickets to like a whole high school basketball game and give 1 to 2 tickets to each of your customers, it's usually enough to just record a general description of the recipients. All right, so let's go to the next slide, because this is really important. Supporting documents for transportation costs. Now, if you incur transportation expense while conducting business, you have to maintain the following information. You have to, your record has to include the cost of each separate expense and the date of the expense. It has to include the cost of the car and any improvements made to the car. It has to include the date that you started using that vehicle for business. Your records also have to reflect the mileage for each business use and your business destination. It also has to reflect the total miles for the year. And lastly, it has to reflect the business purpose for the expense. So the records that you're going to keep for your car and truck expense are going to vary depending on whether you claim the standard mileage rate or actual car and truck expense. But regardless of which method you choose, you have to keep a mileage log if you're using one vehicle for both personal use and business use. Generally, your mileage log should include the date of travel, the destination, the business purpose of the trip, as well as the total miles for the trip. Now, if you're claiming the standard mileage rate, you're going to need a record to show the total miles driven for the year. So when I was an auditor, we would typically request a service record from the beginning of the year, as well as a service record from the end of the year. Because the service records usually include the odometer reading at the time the service is performed. And so that's why we would request that record. It would give us an idea of the total miles driven on the vehicle during the year. And if you choose to deduct actual expenses, and this is everything from repairs, gas, insurance, etc., you are going to need to keep all of those records associated with operating the vehicle in addition to that mileage log. So again, now what I will say is, again, we have a lot of advances in technology. If you have a phone, you could probably do a search in your app store for mileage tracker, and several options will pop up. So I would suggest reading reviews for those apps, maybe getting recommendations for from other business owners, and just test out the apps until you figure out which one works best for you. Because again, not many people are keeping the pen and paper logs anymore, and the electronic mileage trackers, the apps, are sufficient for recording that information as well. All right, so let's go to the next slide. All right, so this is just table 5-1, and it can be found in publication 463, which is the publication Travel, Gift, and Car Expenses. And this table is found in chapter 5. So basically, this is a summary of records that you need to prove each expense that we just went over: travel, gift, and car expense. So you have to be able to prove the elements listed across the chart, and you prove them by having the information and receipts where needed for the expenses listed in the first column. And let's move on to the next slide. And this is table 5-2. This is just an example of a worksheet that can be used to document your business mileage and expenses for your vehicle. But as I mentioned before, there are so many apps available now that document mileage. So just make sure you research the best apps for tracking mileage. And if you prefer, using an app to pen and paper, I know that there are apps out there, like as soon as if you let them run in the background, as soon as you get in the car and take off, they immediately start tracking your mileage. So, and then at the end of your trip, the app, it'll ask you, like, was this a business trip? And if it was, then you just, you fill in the details for that trip and it'll record it for you. So again, there are apps available. Find the best one that works for you.
Anika, we have a question.
Mm-hmm.
Is there a cost limit to send subcontracting staff to training? For your information, our average cost of training is between $400 to $800 per staff.
Okay, repeat the question one more time.
Is there a cost limit to send subcontracting staff to training? FYI, our average cost to training is between $400 to $800 per staff.
No, I'm not aware of any limits for, if you incur an expense to train your staff, I'm not aware of any limits on, the cost of training your staff. As long as you can establish that the expense that you're incurring is an ordinary and necessary expense for the operation of your business, and you can document it, there shouldn't be any issues.
There was another question concerning a specific app, if it would be good enough for the IRS. So when a business is using, for example, the mile tracking type of app, what exactly should a business look out for with information that this app should be collecting for them to be able to use if they have to, well, when they submit their information to the IRS?
Well, a lot of times, and I'm not familiar with every app, but in my experience, the app is just really going to capture, it either automatically starts when you start driving, or you have to go into the app and manually have it start tracking your mileage. And then, but you have to fill in those small details for your trip. So the app is only going to tell you, okay, you just drove X amount of miles. But it should give you the options to add details for that trip, like notes for that trip. So, it'll say you drove X amount of miles, but in your notes, you want to say that I met with, I'm just using as an example, I met with XYZ client to discuss such and such. And also in that note, make sure you include the destination. So like if you travel to your business office to Arlington, Virginia, you want to just make sure that you add those details, because again, you want to make sure that your mileage record includes the destination, the business purpose, and the total miles for the trip.
Thank you. And then another question, if the vehicle is used 100% for the business, do you have to keep a daily business mileage and expense log?
If you establish that the vehicle is used 100, if you can establish and like prove that and I'm talking from an auditor perspective, if you can prove that the vehicle was used 100% for business, then a mileage log isn't necessary, because it should be every time you get in the car, it's a business trip if it's 100% business use.
And then
But if you're claiming, actual expenses, you want to make sure that you're keeping the records associated with that. So again, your tax advisor or your business advisors, they're going to know your business better than I do. So I would just sit down and have that conversation with them.
And then the last question, if the vehicle is used for business only, can we deduct the registration fees and insurance costs?
If you're deducting actual expense, absolutely. If you're deducting mileage, no, because it's either or. But if you're deducting the actual expense, then you can deduct any cost associated with operating that vehicle.
Thank you. Back over to you.
All right, awesome. All right, so let's move on to the next slide because we're going to talk about assets. Can you advance the slide for me, Wendy? Okay, thank you.
My bad.
All right, so no problem. The next expense that you might incur in business are for, well, assets, excuse me, because assets aren't expenses, they are assets. These are the property that your business owns, such as machinery and furniture that you use in your business. So you have to keep records to verify certain information for business assets. And again, the records that you keep for assets are going to be a bit more detailed because unlike expenses where you deduct the expense in the year that you pay it, assets are a little bit different because they assets have a useful life beyond 1 year. So instead of taking the deduction in the year that you purchased the asset, we have you spread that deduction over the life of the asset. And depending on what type of asset you purchase, the life of the asset can be different. So, and just to give you an example, because I know this one off the top of my head, if you purchase a car for your business, the life of the car, the life of that asset is 5 years. And you would depreciate the cost of that car over the period of 5 years. Now, there are some exceptions. There are some depreciation exceptions, and when you get your taxes done, you sit down with your tax pro to talk about those, the Section 179 or the special allowance, which allow you to depreciate assets faster. But if you're depreciating an asset traditionally, it's usually over the life of that particular asset. So the type of documents that you would need to support the asset or associated with that asset, they have to include when and how you acquired the asset. So if your asset is a car, it will probably be the bill of sales for that car. It could be loan documents for that car if you financed it. The documents also have to include the purchase price. If you've made any improvements to that asset, let's say if the asset is a vehicle and you had to get it, maybe it's a shuttle bus, maybe you have a transportation company and you had to get it fitted for, lift equipment. That would be considered an improvement to that asset. So you would have to have documents that support the cost of that improvement. If you do take the Section 179 deduction for the asset, you also have to have record of that as well. You have to have record of any prior deductions for depreciation on that asset. If there were deductions taken for a casualty loss, maybe you lost that asset in a fire or a storm, it has to be record of that as well. Your document should also include how you use the asset. And if you sold it, you need to keep record of when and how you, I shouldn't say sold, but disposed. So if disposal could be, maybe you junked it, maybe you sold it, but either way, your documents have to reflect when and how you disposed of the asset. If it was sold, you have to have documents that support the selling price. And if there was any expenses related to the sale of the asset, you have to have documentation for that as well. So, again, purchase and sales invoices or cancel checks that include the payee, the amount, or the proof of payment, these could all be considered sufficient documents for verifying this information. And also, if the asset happens to be real estate, then your real estate closing statements also include a lot of this information. So that would be considered sufficient documentation as well. But I want to mention to you all, again, because you depreciate assets over a period of time, make sure you keep record of all your depreciation schedules. Depreciation to schedule generally lists all of your assets. It lists the year that it was placed in service, and it lists the depreciation taken for that asset over time. So while they're a really good record to keep. So make sure you guys are keeping your depreciation schedules. All right, next slide. All right, office in the home. So some of you may maintain home offices, which is perfectly fine. But you also have to keep records that provide the information needed to figure your deduction for your home office. You can keep canceled checks, you can keep receipts, and any other evidence for expenses that you paid. But your records must show the following information. They have to show the part of the home that you use for business. This could be documented by, it could be documented by photos that you take. It could be documented using the floor plan for your home. It could be documented from the real estate listing from when you purchased your home, because generally it lists all the rooms and the sizes of the rooms. But you want to be able to document the part of your home that you use for business, but not only the part of your home, but the size of that part of your home. You also need, your records also have to show that the part of your home that you use for business is used exclusively and regularly for business, as either your principal place of business or as a place where you might meet or deal with clients or customers in the normal course of your business. And then, of course, your records have to reflect any depreciation and expenses for the business part of your home. So make sure, I know we just talked about assets, but make sure that you keep records that are going to prove your home's depreciable basis. This includes records of when and how you acquired your home, as well as the original purchase price, any improvements that you made to the home, as well as any depreciation that you've allowed because you maintain your home office. You can keep copies of the Form 8829, because that's the form that you use to compute your home office expense for Schedule C. Or you can, in Publication 587, there's a worksheet to figure your deduction for your home office. You can keep that as a record of depreciation as well. All right, so the last thing I want to talk about is employment records. Now, if some of you hire employees, there are going to be specific employment tax records that you have to keep, and you're going to need to keep all of these records of employment for at least 4 years after the filing of the fourth quarter return. But some of these records you may keep for as long as you keep this person employed in your business. So some of the records that should be kept for employment taxes are going to include, of course, your employer identification number, your EIN. So hopefully you guys have that in a safe place. You're also going to have record of amounts and dates of any wages, annuities, and pension payments that you make. You're going to need records of amounts of tips reported to you by your employees, a record of any allocated tips. If you pay in-kind wages, then you're going to need a record to show the fair market value of those in-kind wages. So for example, if someone works for you for in exchange, maybe they collect a smaller wage because you let them, you house them, or they pay a reduced rent, then you're going to need the information on the fair market value of that exchange. Your records are also going to need to include the names, addresses, social security numbers, and occupations of your employees. Also, you're going to need keep records of the dates of employment for each of these employees. And you're going to need copies of the employees' income tax withholding certificates. These are the Form W-4s. And then when it comes in regards to the payment of the employment tax, You're going to want to make sure that you have record of the dates and amounts of your tax deposits that you've made, and also the acknowledgement numbers for those deposits made by EFTPS. And also make sure you keep copies of the actual employment tax returns. And if they're filed electronically, make sure you keep copies of, have record of those confirmation numbers. And then lastly, if you offer any fringe benefits to your employees, maybe you offer tuition payment or childcare reimbursement, make sure you keep record of that as well. So last and final slide, let's talk about record keeping timeframes. Now, the length of time that you keep documents is going to depend on the action, expense, or the event which the document records. So generally, you have to keep records that support an item of income, deduction, or credit shown on your tax return until the period of limitations for that tax return runs out. The period of limitations is the period of time in which you can amend your tax return to claim a credit or refund, or the period of time that the IRS can assess additional tax. So generally speaking, if you've timely filed your return, you want to keep records associated with that tax return for 3 years from the date that you've filed the tax return. Now, if you do not file the tax return, then of course you have to keep these records indefinitely. So don't get rid of your records, because eventually we're going to come to you and say, hey, you didn't file these tax returns. Also, and I know this might sound crazy, but you want to keep the records indefinitely if you are filing fraudulent tax returns. And then, of course, I mentioned previously in the last slide, if they're employment tax records, then you're going to want to keep those records for at least 4 years after the date that the tax becomes due or is paid. Now, generally speaking, when it comes to keeping records for your assets, you want to keep those records related to your assets until the period of limitation expires for the year in which you dispose of the property. So, for example, your car, even if the 3-year time frame has passed for that particular tax return, if you still have the car, make sure you have the records associated with depreciating that vehicle, at least until you dispose of that property. You're going to have to keep any records associated with figuring the depreciation or amortization, and any records that are going to figure the gain or loss when you sell or dispose of that property. And as a good practice, even if you don't need the records any longer for tax purposes, don't get rid of them right away, because you might have to keep them longer for other purposes. So for example, if your insurance company or creditors require you to keep or retain records for a certain period of time, make sure you keep those records. And if you want to purge records, just follow up with your creditors or your insurance companies to make sure it's okay to let go of those records. Next slide. So the next 2 slides are just some resources available for small business owners. The first one listed here is publication 583. That's starting a business and keeping records. Chapter 5 is where you're going to find the most information regarding record keeping for your small business. And then you have publication 463. That also includes some information regarding record retention for travel, entertainment, gift, and car expenses. Publication 15 is going to be where you'll find some record keeping information for for employees. And then publication 587 is going to give you some record keeping information for your office in the home. Next slide. And then these two links here are just links to the actual IRS web pages where you'll find information for record keeping in general, and then also employment tax record keeping. And that is all I have. So Wendy, I'm gonna turn it back over to you and to see if we have any more questions.
Thank you. I know that we had a few questions. Give me 1 second. I'm sorry. Some of the questions that we do still have pending are more tax questions than record keeping questions. And due to the time limits that we have, I know, Anika, y'all have a session that's coming up, I think May 8th. Is that correct?
I don't, I would have to follow up with Cheryl. May 8th doesn't sound familiar.
Okay, it might have been an old session. I'm sorry.
Okay.
Because I was trying to see, I know, I thought that it was there. If it is, then I'll send it out in a notification to everyone.
Okay.
It might have been an older one when I was looking in the mailbox. Apologies.
Okay.
It's difficult trying to do multiple things with just 2 screens here. So everyone, for your questions that we were not able to cover today that were not specific to just record keeping, I know there are a few questions specific to like filing the taxes for your business. Can you, I think one of the questions was, oh, I think you answered that one, Cheryl. Yeah, you did. Like deductions and those kind of things. We will follow up after this session. I'll send the questions over to Anika and Cheryl so that we can get a response to you, and I'll send it out in an email. Before we leave today, I do want to give a special thank you to you, Anika and Cheryl, for joining us again, as always, and helping us to basically close out Financial Literacy Month. Tomorrow will be the last day of April, and again, April is Financial Literacy Month. Your expertise, you, Anika and Cheryl, and your engaging style made this session not only informative, but also enjoyable. We appreciate those valuable tools and strategies that you shared, which will undoubtedly aid the participants here today as they continue to manage their business finances. For the participants, I want to also thank you for attending. We look forward to seeing you at our future events and continuing to support one another in our journeys towards financial literacy and business excellence. Thank you, everyone. This concludes today's session.